Hello, my name is Omer Kareem, and today we will be having a discussion on financial services, credit risk analysis. Uh, to begin, let's talk about the critical importance. So the being affected by financially, is something that we all fear as humans, and financial industries they encourage individuals to take upon investments that will stimulate the economy. So, for example, I just purchased a house, and despite the interest rates being high, the price of the house is reasonable. So the um, the positive, it has its positive and negative to it. The positive is that the fact that the price of the house was lower, and of course the negative is that the interest rates are so high. But I still decided to purchase the house because interest rate, even though it's higher, but in the it doesn't in the later on, if I'm able to secure a house now, later on when the interest rates do go down, I would be able to refinance my house. Despite the interest rates being higher in the past, in the past years, it has not stopped people from taking out loans. Uh, we in the recent years, we have seen an increase on the housing market. Um, so the risk is something that is unavoidable. When the bank issues a loan, there's a risk that the loaner will default. So the banks protect themselves, and they having the loaner pay. By what they do is they have you pay their interest, their money first. So the paying off their interest is the first, and of course the interest is how the banks make their profits. And when we so looking at our pension funds, they fluctuate. So depending on the market, if the market is doing well, our pension rises, and it does well as well and then uh, if the market is not doing well, then it will operate at a loss. During the 2008 financial crisis, a lot of people defaulted on their loans and lost a hefty amount of money in their pension funds. Speaking about the history, the historical background on it, um, the credit score is like a background on a financial stability of a person. Scores are important. It shows how responsible a person is and how financially stable they are. How with good credit score, it is evidence that the person is financially responsible and in good financial standard. Good credit score also allows the banks to trust that the person is responsible enough to pay their bills and debts on time. When buying a house, the and applying for mortgages, the bank officer advised they advise like not to take any other loans or fill out any other loan applications, because it can affect the credit score. Because each time a loan is taken out or applied for a loan, the credit score takes a little bit of hit. If the bank sees that, oh, you have multiple loans to pay off, there's a lower credit score and higher chance of being denied for the mortgage, for the mortgage that you're trying to apply for. So the financial service industry, the financial is always looking to better ways to improve their services and attract new customers who would use their services, for the bank services. Um, major banks such as Capital One, Chase, they always have new customers, new promotions range from providing monetary incentives to customers to increase the cash bank to increase the cash back on the customers that could receive. So the Chase, an example would be like a Chase Freedom card is a credit card that offers customer 1% cash back on like specific purchases such as restaurants or supermarkets. And a few down the road, I think a year or two later, you can upgrade it to uh, higher interest percent. For example, if I remember correctly, my Chase Freedom is went up to 1.5% back on every purchase that was made. It makes the customer happy and encourages new customer to apply. Anybody I speak with, oh yeah, I received 1.5 back on my purchases, so I'm happy about that, and I would recommend to other people that I may know. Banks and it is important. Banks and the analytics. Uh, it is surprising that more banks did not use the fiscal score prior to providing the loans or credit scores. The fiscal scores help paint a picture of a customer, just like a background check, basically. Uh, paints a picture of a customer's financial standing. Without a fiscal score, the financial institutes are giving their services blindly. By blind, I mean that it doesn't have a glimpse on the financial stability of the customer. Giving $500,000 to somebody without knowing if they have the financial stability and ability to pay it off is ludicrous. Uh, Capital One did the right thing. I think it was one of the first banks, I believe, that they try to get as much information on customer prior to providing or approving them for bank services such as loans or credit cards. And any financial institute needs to know that a customer will pay off their loans in timely manner. Um, so the senior management, the CEOs, they encourage the analytics and the quantitative analytics analysis to better understand the behavior of customers. Quantitative analysis is using mathematics and statistics, modeling measurements to understand behavior. Capital One is stands out is the one that use the analytics to understand how to approach the market. It shows the possibility on how to approach the customers, perhaps by providing lower minimum balances and other approaches to attract new customers. Banking is data driven, just like everything else these days. Social medias, everything is heavily on data, as are banks. So banks are also data driven. Banks collect data based on their customer database to ensure they're providing the correct services for their customers. Some services are tailored to their some customers. For example, there are customers who travel a lot, and based on their credit activity, uh, use credit use the credit card use activity. The banks have specific cards and lower fees on, for example, lower fees on foreign transactions, and they even offer better deals for travel expenses such as ticket purchases. Financial industry, despite there being rules and regulations, there is always a chance financial institute will fail. And the Great Depression is a great example for that. Um, Models to attract a customer is designed by humans that could be exposed to explicit or implicit bias. Being able to fully review fiscal score is important, and with artificial intelligence, it would make it easier to review and make suggestions for product recommendations. However, making mistakes does not take place with however, uh, with the AI evolution, it can be um, attributions to programming deficiency, fraud detection, uh, faulty data, or many more aspects of it. So the AI is a great resource, but it does have its flaws. And to conclude this presentation, AI is a great tool, and to have each uh, to have at each financial institution disposal at their disposal. How Even though it is a great tool, but it does come with its own risks. Machine learning is able to predict human behavior. However, it cannot assess risk taking. It is learning institutions through data, and data might not show in its true risk. Sometimes so-called human feel, human touch is required. Humans are able to feel risk, right? At times, banks will require certain documentations to process loans or other banks services that they're providing, and sometimes documents will paint a picture of a financial standard, but sometimes it might not paint an exact picture, or a better picture perhaps. And this is where the human feel will come into identify what artificial intelligence is not able to, or is unable to. I hope this was a good presentation. I hope you enjoyed your time. I thank you for your time, and I'll see you next time.